Hello, everyone. This is Rob McDougall with Zhang Financial here with your weekly economic update. Today is June 22nd, 2026, which is a Monday. In terms of economic activity last week that was reported, very little. Wednesday, we did have the Fed rate decision exactly as expected, no change. So interest rates, the Fed fund rate targeted between 3.5 and 3.75. So that's no change. Retail sales came in both month over month for May, ex-autos and headline number, both much better than expected. The expectation was a 0.5% increase month over month for the month of May. The headline number came in at positive 0.9 and the ex-autos came in at positive 0.8. Very solid. Also, we had the initial jobless claims and the consensus overshot once again. We had that period of 3 months where it seemed virtually every week they did. Then they caught up. Well, in this case, they did overshoot. So the expectation was 232,000 new claims, came in a little better than expected at 226. Now this chart, inflation expectations, the 10-year break-even shows virtually every week. This is a very impressive retreat. We had mentioned with the Iran situation, oil prices, certainly inflation moving up, that this metric had moved up to over 2.4% after being solidly around 2.2% for quite some time. Well, it has rolled over and has been moving down seemingly weekly. So now the expectation is for inflation, the average over the next 10 years built into the markets is 2.25%. That dropped 4 basis points last week. In terms of GDP expectations here for the second quarter, the Atlanta Federal Reserve, they did take down their estimate a little bit, but still they expect very solid growth of 3% in the second quarter. It had been at 3.3% the week before. Fed funds rate, we do have another Fed meeting next week. As we mentioned, we had one last week, no change. But the July meeting, the expectation of a rate hike has now risen to 42%. This will be very interesting because we do have a new Fed chairman, Kevin Warsh. It's Trump's pick. So you expect that individual to be very aggressively holding the line or trying to cut rates as soon as possible. So we would think that'd be a little improbable that in his only a second meeting, that he would move rates up, but I guess it's possible. And the markets say 42% probability of that happening. Now, by the end of the year, the expectation, again, no expectation of rate cuts by the end of the year, only 10% probability built into the markets that there will be no cut and no change. But 32% odds of a one hike, 25 basis points, 37% odds of 2 rate hikes, and 21% probability of 3 or more hikes. So that's a backdrop from last week. Let's just take a look at how the markets did last week, starting with U.S. equities. Solid week. The S&P 500 up nearly 1% on the week. And the things that stood out last week is that large cap growth worked well, and in particular the Mag 7 up 1.25%. But then when we take a look at a year-to-date basis with the S&P up a very solid 10.2%, the Russell 2000 small cap more than double that at a positive 20.7%. And on a year-to-date basis, the Mag 7, our equal weighted calculation of it, barely flat on the year, positive 0.28%. In terms of international markets last week, the developed markets ex-US up 0.45%, half of what we saw for the S&P 500. So now on a year-to-date basis, S&P 500 return better than the MSCI World ex-US, which is up 9.4%. However, the emerging market, another great week for that. Emerging markets were up 4.15%, and on a year-to-date basis, up 28.3%. What makes this even more impressive is the fact that China is roughly 30% of that index. China equities were down 2.8% last week and down 11.4% year to date. So what is pulling this index ahead as strongly as it is? It's Korea and Taiwan, semis, and anything AI related. Fixed income last week, relatively flat. The 2-year yield was up 9 basis points, but the 10-year down 3 basis points. So the Bloomberg U.S. Aggregate Bond Index up 0.14% for last week, and now year to date up about 0.5%. But the one thing to note here on this chart is simply that if you were betting on the yield curve getting steeper, as many were, that definitely has not happened this year. On a year-to-date basis, that's gone the other way by 43 basis points, very significant. So the yield curve is actually flattened with the 2-year coming up and the 10-year not going up nearly as much. So let's take a look at the economic data that will be released this week. We cut out some of the tertiary housing metrics that never seemed to move the markets, and we did, as we promised, got rid of the University of Michigan Consumer Sentiment Index. So we think everything that happens economically this week in terms of releases will happen on Thursday. Initial jobless claims, as always, expectation is pretty much the same as we saw last week, 225,000. Both personal spending and personal income for the month of May expected to have improved from the month before. For personal income is actually flat in the month of April, expected to be up 0.4% for the month of May. And then personal spending was up 0.5% in April, expected to be up a little better than that, 0.6%. Probably the most watched number this week will be the PCE, both the core and the PCE headline number. The expectation for PCE headline for the month of May, exactly as we saw in April, which is a little bit of a surprise given energy prices and feeling like inflation's accelerating. But consensus is a increase month over month of 0.4%, and then core, stripping out food and energy, for the month of April, that was up 0.2%. That is expected to accelerate to a positive 0.3%. Durable goods orders for the month of May, that's expected to be down 4.7%. Not really sure why. Probably because the month of April was as strong as it was. That was up nearly 8%. So last metric that will be released is the GDP final growth rate for the first quarter. It had initially been reported at 0.5, but with all the revisions so far, the expectation is the actual GDP number growth rate for the first quarter this year, positive 1.6%. Well, that is it for our economic update. We thank you so much for attending. We'll look forward to seeing you next week. Thank you.